Most people think a credit score is a measure of how responsible you are with money. It isn't. A credit score is really just a prediction tool. Lenders use it to estimate how likely you are to pay back borrowed money on time. If you've ever wondered why your score drops after doing something that seemed smart, or why people with debt can still have good credit, this is why. Your credit score is not grading your character. It's grading your behavior as a borrower. By the end of this video, you'll understand what a credit score actually measures, what affects it the most, and what to focus on if you want to improve it. A credit score does not measure how much money you have. It does not measure whether you're wealthy. It does not even measure whether you're financially stress-free. Someone can make a high income and still have a bad credit score. Someone else can make an average income and have an excellent one. Because credit scores are mostly about how you handle debt. If a lender gives you money, they want to know one thing. What are the chances you'll pay it back as agreed? The first and most important factor is payment history. This is basically your track record. Do you pay your bills on time or not? If you miss payments, especially by 30 days or more, that can hurt your score a lot. If you only remember one thing from this video, remember this. Paying on time matters more than almost anything else. The second big factor is credit utilization. This is the amount of your available credit that you're using. Let's say you have a credit card with a $1,000 limit and your balance is $800. That means you're using 80% of your available credit. To lenders, that can look risky because you're close to maxing out the card. Now imagine you only owe $100 on that same $1,000 limit. That's 10% utilization, which usually looks much better. This is one reason people get confused. They may pay their credit card on time every month and still have a lower score than expected. The issue may not be late payments. The issue may be that they're using too much of their available credit. In general, lower utilization is better. The third factor is length of credit history. Lenders like to see a longer track record. If you've been using credit responsibly for years, that's more reassuring than someone who just opened their first account last month. This is why closing old credit cards can sometimes hurt your score. That doesn't mean you should keep every card forever, no matter what. But it does mean you should understand that older accounts can help your credit history. The fourth factor is credit mix. This just means the different kinds of credit you use, like credit cards, auto loans, student loans, or a mortgage. Having a mix can help a little. But for beginners, this is not the thing to focus on. You do not need to go borrow money just to improve your mix. The fifth factor is new credit inquiries. When you apply for new credit, lenders may do what's called a hard inquiry. Too many hard inquiries in a short period can make you look risky. One inquiry is usually not a huge deal. But applying for 5 different credit cards in 2 weeks is a different story. Credit scores don't ask, "Do you hate debt?" They ask, "Do you manage borrowed money predictably?" If someone uses a credit card, keeps balances relatively low, makes payments on time, and has a long history of doing that, they can have a strong score, even if they still have debt. On the flip side, someone can avoid debt most of the time, but have a weak score if they have little credit history or missed payments in the past. If you want to improve your score, start with the basics. Pay every bill on time. Keep your credit card balances low relative to your limits. Don't open too many new accounts at once. Be careful about closing old accounts, especially if they have no annual fee and are helping your history. Check your credit reports for errors. A good credit score is useful, but it's not the same thing as financial health. You can have a great score and still be broke. You can have a great score and still be paying too much interest. You can have a great score and still have no savings. So don't treat a credit score like the final goal. Think of it as a tool. Imagine 2 people. Person A has one credit card with a $2,000 limit. They owe $1,700, but they always pay on time. Person B has one credit card with a $2,000 limit. They owe $200 and they always pay on time. Both have perfect payment history. But person B may look less risky because they're using much less of their available credit. Your credit score mainly reflects 5 things: whether you pay on time, how much of your credit you're using, how long you've had credit, what kinds of credit you have, and how often you're applying for more. If you're trying to get your money under control, Understanding credit is one of the best places to start.